This is a dollar bill. It's Series 2017A, printed at the Bureau of Engraving and Printing Facility in Fort Worth, Texas, one of approximately 12.7 billion notes produced that year. In your hand, it feels permanent. The weight of the paper, the texture of the ink, the familiar face of George Washington staring back with the quiet confidence of a currency that has dominated global finance for 80 years. But this piece of paper is not what it appears to be. It's not wealth. It's not a store of value. It's a claim. A promise that the United States government will honor its obligations, that the Federal Reserve will maintain its purchasing power, and that the systems supporting it will continue functioning as they always have. On January 22, 2026, at 2 p.m. Eastern Time, the Federal Reserve made an announcement that broke that promise. Not explicitly, central banks never say what they're actually doing, but mechanically, in a way that anyone who understands monetary operations recognized immediately. The Federal Open Market Committee announced the resumption of large-scale asset purchases, quantitative easing, at a pace of $120 billion per month, targeting Treasury securities and mortgage-backed securities to ensure adequate liquidity in financial markets and support the continued functioning of credit channels. The last time the Fed launched QE at this scale was March 2020, during a global pandemic that shut down the world economy. There is no pandemic today. There is no acute crisis that justifies emergency intervention. What there is, buried in the FOMC statement's technical language, is an admission that the Treasury market can no longer function without the Fed as buyer of last resort. The dollar didn't collapse at 2 p.m. It won't collapse tomorrow. But the mechanism that will destroy it was activated in plain sight, and almost no one understood what they were watching. Here's what they're not telling you. The Federal Reserve's balance sheet currently stands at $8.4 trillion, down from the $9 trillion peak reached in April 2022, but still more than double the pre-pandemic level. For 3 years, the Fed has been attempting quantitative tightening, allowing bonds to mature without replacement, slowly shrinking the balance sheet toward something resembling normal. That process just ended. Not because inflation is defeated, core PCE remains at 3.2%, above the Fed's 2% target. Not because unemployment is spiking, the labor market remains tight. The process ended because the Treasury market showed stress signals that forced the Fed's hand. On January 15, 2026, the Treasury Department auctioned $42 billion in 10-year notes. The auction was, in technical terms, a disaster. The bid-to-cover ratio, the measure of how many buyers competed for each dollar of debt, fell to 2.14, the lowest since 2009. The yield required to clear the auction spiked to 4.89%, 23 basis points above pre-auction trading levels. Primary dealers, the banks required to absorb unsold treasuries, were stuck with $7.8 billion in bonds they didn't want. A failed treasury auction is the financial equivalent of a cardiac event. It means the market that is supposed to be the deepest, most liquid, most reliable in the world could not absorb the debt that the U.S. government needed to sell. And the U.S. government needs to sell a lot of debt. $2.1 trillion in net new issuance projected for 2026, plus $8.9 trillion in maturing securities that must be refinanced. At 6:30 a.m. New York time on January 17th, the overnight repo rate spiked to 6.2%, more than 100 basis points above the Fed's target range, indicating acute funding stress in the short-term markets that lubricate daily financial operations. The spike lasted 4 hours before the New York Fed intervened with emergency liquidity injections. The intervention was not announced publicly until after markets closed. The Fed's QE announcement on January 22nd was the response to January 15th and January 17th. The official language about ensuring adequate liquidity is Fed speak for, the Treasury market is breaking and we have to catch it. This is where the lie becomes unsustainable. Quantitative easing is not stimulus. It's not support for the economy. It's the Federal Reserve creating money from nothing to purchase government debt that the market won't buy at prices the government can afford. The mechanism works like this. The Treasury issues bonds to fund federal deficits. Normally, private investors, pension funds, foreign governments, insurance companies purchase these bonds, lending money to the government in exchange for interest payments. When the Fed conducts QE, it creates new dollars electronically and uses them to buy bonds, either directly from Treasury or from dealers who purchased at auction. The result is that government debt is converted into currency. The bonds leave circulation, absorbed onto the Fed's balance sheet. The dollars enter circulation, expanding the money supply. The government gets the funds it needs without the market discipline that would normally constrain borrowing. In the short term, this appears to work. Interest rates stay low, treasury auctions clear, financial markets stabilize. The system continues functioning. In the long term, it destroys the currency. Every dollar created through QE dilutes every existing dollar. The expansion of money supply without corresponding expansion of goods and services is the textbook definition of inflation. The purchasing power that your savings represent is transferred to the government's spending priorities without your consent and without explicit taxation. At $120 billion per month, the Fed will create $1.44 trillion in new money over the next year. Added to the existing money supply of approximately $21 trillion, this represents a 6.9% annual dilution, on top of whatever inflation is already occurring. The Fed's own projections show balance sheet expansion continuing through at least 2028. The cumulative creation, approximately $4.3 trillion in new money over 3 years. The cumulative dilution, 20% of the dollar's purchasing power, assuming money velocity remains constant, which it won't as inflation expectations become embedded in economic behavior. This is not a prediction of collapse. It's a description of the mechanism that produces collapse, now officially activated. When institutions do this, they're not managing risk, they're containing disaster. The Fed's decision reveals a trap that has been building for decades and has now become inescapable. The federal debt stands at $36.4 trillion. The weighted average interest rate on that debt is 3.1%, producing annual interest expense of approximately $1.13 trillion. Interest expense now exceeds defense spending. It will exceed Social Security within 4 years at current trajectory. Here's the trap. The Fed cannot allow interest rates to rise to market clearing levels because the Treasury cannot afford the debt service. A 10-year yield of 6%, historically normal, would add approximately $400 billion in annual interest expense as existing debt is refinanced. A yield of 7% would add $600 billion. At some threshold, interest expense consumes so much of federal revenue that primary deficits become mathematically impossible to close. But the Fed cannot hold interest rates artificially low without creating inflation that destroys the dollar's purchasing power. QE suppresses rates by creating artificial demand for bonds, but the new money that funds those purchases enters the economy and bids up prices. The Fed is choosing between two forms of default: explicit default, where the government fails to make payments on its obligations, or implicit default, where the government makes payments in dollars that are worth progressively less. Every central bank in history facing this choice has chosen inflation. The Fed just confirmed it will do the same. On January 23rd, the day after the QE announcement, the 5-year break-even inflation rate, the market's projection of average inflation over 5 years, jumped from 2.4% to 2.9%. The 10-year break-even jumped from 2.5% to 3.1%. Bond traders understood immediately what the Fed was signaling. Inflation targets are now subordinate to Treasury market stability. Prices will be allowed to rise as much as necessary to prevent a debt crisis. Less than 48 hours after the announcement, gold futures rose $87 per ounce, the largest 2-day gain since March 2020. Bitcoin rose 12%. The euro gained 2.3% against the dollar. Markets are pricing in dollar debasement that Fed statements officially deny, but Fed actions explicitly confirm. While one side prints, the other side exits. The Fed's announcement did not occur in isolation. It occurred against a backdrop of accelerating de-dollarization that makes dollar creation increasingly risky. Foreign holdings of U.S. Treasury securities have declined from $7.7 trillion in October 2021 to $7.1 trillion in December 2025, a reduction of $600 billion that represents foreign central banks and sovereign wealth funds reducing dollar exposure. The decline has accelerated since 2023, with China reducing holdings by $180 billion and Japan by $120 billion. The reductions are not sales, they're non-reinvestment. When Treasury holdings mature, foreign holders are taking their dollars and not buying new treasuries. The question is what they're buying instead. Central bank gold purchases provide one answer. Global central banks acquired 1,280 tons of gold in 2025, the third consecutive year above 1,000 tons, a pace not seen since the 1960s. China has added 320 tons to official reserves since 2022, though actual accumulation through unreported channels may be double that figure. Russia has increased gold's share of reserves to 32%. India, Turkey, Poland, and dozens of smaller nations are accumulating at record rates. Gold cannot be printed. Gold cannot be frozen by foreign governments. Gold cannot be diluted by central bank balance sheet expansion. The shift from dollar reserves to gold reserves is the revealed preference of nations that have concluded the dollar's trajectory is no longer acceptable. On January 19, 2026, 3 days before the Fed announcement, the People's Bank of China reduced its treasury holdings by another $21 billion, the largest single-month reduction since August 2023. Chinese authorities did not comment on the reduction. They didn't need to. The timing spoke for itself. China anticipated the Fed's move and positioned accordingly. The BRICS bloc has accelerated development of alternative payment systems. The mBridge project, a central bank digital currency platform linking China, Thailand, Hong Kong, UAE, and Saudi Arabia, processed $12 billion in cross-border transactions in 2025, up from $2 billion in 2024. The system enables trade settlement without touching the dollar, SWIFT, or any U.S.-regulated infrastructure. The de-dollarization trend is not reversing, it's accelerating. And the Fed just gave every nation considering dollar alternatives a concrete reason to accelerate further. The Fed will print as much money as necessary to prevent a treasury crisis, regardless of what that printing does to the currency's value. The mathematics of the trap are now inescapable. The federal deficit for fiscal 2025 was $1.84 trillion. Projections for fiscal 2026 show $2.1 trillion. These deficits must be financed through Treasury issuance. Treasury issuance must find buyers. If private buyers are insufficient, and January 15th proved they are, the Fed becomes the buyer of last resort. Fed purchases create money. Money creation causes inflation. Inflation increases the nominal cost of government programs, many of which are indexed to prices. Social Security, Medicare, federal pensions, and interest payments on tips all rise with inflation. Rising costs require larger deficits. Larger deficits require more Treasury issuance. More issuance requires more Fed purchases. The loop is self-reinforcing. Each iteration makes the next iteration larger. This is the fiscal doom loop that economists have warned about for decades, now visibly operating. On January 24th, the Congressional Budget Office released an unscheduled revision to its 10-year budget outlook. The revision showed cumulative deficits of $22.3 trillion through 2035, $4.1 trillion higher than the previous projection issued 6 months earlier. The primary drivers of the revision: higher interest rate assumptions and the inflationary effects of resumed QE. The CBO's projections are historically optimistic. They assume no recession, no new spending programs, and no crisis requiring emergency response. The actual trajectory will be worse. The question is not whether the deficit spiral continues, but how fast it accelerates. The Fed has no exit strategy. Ending QE would allow Treasury yields to spike, triggering the debt crisis that QE is designed to prevent. Continuing QE ensures inflation that erodes the dollar's purchasing power and accelerates foreign de-dollarization. The Fed is choosing the slow death of inflation over the rapid death of default, but both paths lead to the same destination. This is what a system looks like when every option makes the problem worse. The informed are not waiting for official announcements to understand what's happening. Gold has risen 34% since October 2025, reaching $2,847 per ounce, an all-time high in nominal terms. The rise reflects not speculation, but flight, capital seeking assets that central banks cannot dilute. The premium for physical gold over paper futures has widened to 3.4%, the highest sustained premium since 2020. Dealers report 6-week delivery delays on popular bullion products. The market for atoms is separating from the market for digits because atoms cannot be created by committee decision at 2 p.m. on a Wednesday. The DXY dollar index has fallen 7.2% since November 2025, breaking below support levels that held throughout the 2022-2024 tightening cycle. The breakdown signals institutional reassessment of dollar strength that Fed rhetoric cannot reverse. Treasury inflation-protected securities have seen inflows of $14 billion since December, the largest quarterly inflow in history, as institutional investors position for inflation that nominal treasuries will not compensate. The flow represents professional money managers drawing conclusions about Fed policy that differ from Fed statements. Bitcoin's market capitalization has exceeded $2.1 trillion, surpassing silver's total above-ground value for the first time. The milestone reflects a generational shift. Younger investors are treating cryptocurrency as the inflation hedge that older investors seek in precious metals. Both groups are reaching the same conclusion about the dollar through different instruments. The spread between U.S. Treasury yields and German Bund yields has widened to 195 basis points, reflecting higher inflation expectations for the U.S. than for Europe, a reversal of historical patterns. Capital is pricing in American monetary debasement that European policy has not yet matched. The question is not whether the Fed's announcement matters. The question is, who understood its implications fast enough to act before prices adjusted? A piece of paper printed in Fort Worth, Texas. Serial number, security features, the words, "In God We Trust." The symbols of a currency that was once as good as gold and is now backed only by the promise that more won't be printed. The Fed just broke that promise. $120 billion per month, $1.44 trillion per year. Money created from nothing to buy debt that no one else will buy at prices the government can afford. This is not monetary policy. This is the mathematics of currency destruction, executed in slow motion, with press releases that describe it as supporting market functioning. Physics doesn't negotiate, arithmetic doesn't bend to political necessity, and reality, eventually, asserts itself over every currency whose custodians believed they could create wealth by creating claims. The divergence between what the dollar promises and what the Fed delivers has never been wider. What happens next is not prediction. It's $120 billion per month, compounding until the numbers become undeniable. The trigger has been pulled. The only question is how long the bullet takes to arrive.